Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, how you going? Phil Tarrant, co-host of the Pure Property Podcast with Paul Glossop. Here again to peddle his book. It's what he does best. But I'm not going to allow him to do that today. I'm here to talk about other things. But Paul, welcome back to the studio.
Thank you for having me, Philip. And Christmas stocking stuffer time, as we can tell. It's November-ish, if you haven't thought of it yet to date, for your mum, for your dad, for your son, for your daughter, for your friend, for your loved one. Free plus shipping. Jump on to purepropertyinvestment.com, grab a copy of Surface Guide to Property Investing, The Next Wave.
So
Done and dusted, hard copy or audio
I've got some
copy.
notes here. So why, Paul, is this the best stocking stuffer this Christmas?
I'll let you answer that, Philip.
Is it slice, it dice, it blends?
Absolutely. It does it all.
Like
It does it all for you.
Yeah.
And I think our guest a little bit later on might talk about how it can and will evolve your thoughts on how to property invest in the best way possible.
What we're going to do, I don't know if you've seen that lady on the social media from China who sells stuff where she just sort of holds it up for 1 second.
No, I have not.
It's just like she's one of
Brilliant.
the biggest sellers of stuff online.
Literally, just
like literally,
just that.
like literally, she go
gone,
like that,
gone,
like that. Then someone
gone,
she go like
up,
this,
gone.
and she go, "That's what it does. Does this." Yeah, I could probably do that with property books. There's so many of them out there. I go this one, this one, this one. So,
You're not giving me much credit here, Phil. That was 4 years into that book.
Wow, Paul, you only need to pay for shipping. How can you do this deal so good?
How can you afford to do this deal?
Oh,
My
God.
publisher is not stoked about it, to be honest.
Oh,
with you.
really?
Yeah.
Okay.
Yeah. Well, that don't make.
Mate, they're in the
revenue out of
business
it.
of printing books, mate.
They
Really,
are.
they just,
They
that's
definitely are.
your job in distribution. So.
I am the distributor.
Yeah,
Yes, correct.
no. But no, I do give it a hard time, but it's got a great forward in that book, written by me, and then I think rewritten by me by someone else before
with a
the
bit more
next
talent.
iteration, the next wave. But no, go and check it out. I give it a bit of stick. It's pretty practical. So better than probably what I would get as a stocking stuffer, which normally involves cooking meat.
Right. I
It'll
thought you
be
were going to say it was going to be coal or something similar to that.
No,
That's what
no.
we were talking about off air.
No,
Something about
it'll be-
cooking meat. Really.
It'll be
like
like, you
a
know,
thermometer. A meat
No,
probe.
it'll be something like it'll be a book on the 27 best ways to cook a steak.
How
for
not
summer.
to stuff up a
Yeah.
steak, Dad. Literally.
Yeah, how to cook for 500 without burning your steak. That's what I'm all about. I've got a pretty good steak cooking setup, so
Right.
I can cater for the masses, much
Okay.
like your book.
Yeah,
it caters
absolutely.
for the masses.
Yeah.
There you go, all investors.
Nice one.
All investors. But production team, insert the jingle now. What's making property news? Here we go.
What's making property news?
All right, Paul, we always kick off our podcast with what's making property news, get a bit of sense for what's happening in the market. We're recording 2 days after the Melbourne Cup. Did you have a punt? I know
I didn't. I didn't
really?
even
You
bother. this
love
year.
a punt.
On property, yes. On nags, no, not so
I
much.
thought you always liked a little bit of a flutter.
Look, I came from a long lineage of flutterers,
Yes.
but it probably led to me not want to flutter.
Okay.
If you get what I
Mate,
mean.
I was in Bunnings looking at kitchen tops
Really?
when the race was on.
Wow.
Yeah, there you go.
It's
So I don't know if
the heady heights of of mass property.
always on duty,
investment,
always on
never
duty,
ending.
out there.
On a Tuesday at 3 p.m.
Yep.
looking at laminate bench tops from Bunnings.
Well, I was actually looking at a real
Faux stone.
No, it wasn't faux stone. it was natural timber laminate
gotcha.
bench top.
Yes, the
with-
the one that's all sliced and diced together, no
Yeah,
doubt,
yeah.
and put through the plane, and it's got a whole
that's
bunch.
the one.
Basically,
yeah,
the butcher's block top.
that's right. Yeah, doing a bit of reno. But I'd like to do a shout out to the kitchen bloke at Bunnings in Chatswood.
Oh yeah,
He was excellent. His name was Rob.
nice one, Rob. Of course,
So
it was.
shout out to any Bunnings workers. I love Bunnings. I spend a lot of time in Bunnings, and I have a power pass. You have a power pass?
I don't even know what that is.
Yeah, see, this is the problem.
th-
He's not a
there's-
real investor. He doesn't know
no.
what he's doing.
No calluses.
No, but November, the rate announcement, as anticipated. I think
Yes.
people were sort of getting a bit maybe jittery a couple of weeks beforehand, but as expected, No movements on rates. I listened to the Reserve Bank governor do her commentary and press conference afterwards, and at no point did she say that the board was considering moving rates.
No.
Leading up to the rate announcement, despite some commentary in and around it. And I think what really led to that was inflation data come out, which has made a lot of people quite edgy. It's bounced back up above the target range. So I wouldn't be expecting any interest rate cuts soon. And there was some people sort of putting a question mark around whether is the next movement up to try and stifle increased spending. Housing was a big contributor to the inflation data.
Electricity
and
was
electricity
from
and
there,
power.
yeah.
So you've got this debate in and around at the moment, sort of net zero, making power more affordable, whereas sort of net zero, some people would be saying it's making it more expensive. So why should Australians have to bear the brunt of leading climate change when they're absorbing these power prices, when we ship all of our power offshore to other people who have different emissions views
and standards,
and we're copying it. So this is how the economy works. But any concerns, any worries?
Not really, mate. I think when you see it more broad-based, that's where I'd be more concerned. But when you start to see these big outliers, i.e. power and to a smaller extent housing, the power side of things, I think, and it's been done plenty of times in the past, that there are ways to adjust the impact on power prices. Now, it doesn't necessarily address the cause of why power prices are so high. I think we've got some bigger issues that need to be addressed there. But I think there's ways to subsidise, and they've shown that in the past. So if this stays sticky, i.e. close to 10% increase, which it is, that can be addressed from an inflationary standpoint. I think more of the basket of goods scenario seems like it's probably still relatively in check, taking out a few of those outliers. So if it was the basket of goods scenario all seeing increases across the board, that would make me thinking, these rate increases might be more quicker or sooner than we expect, and might be more pain in the short term coming. But I think it's still going to be somewhat lumpy for the next few quarters ahead. So, is there going to be another cut in December or February? Highly unlikely. Is next year, 2026, going to hold one or two as per what the discussions were only maybe 2 or 3 months ago? Unknown at this stage. I think if you're doing your math, probably do it on status quo. There'll be potentially a bonus if it gets cut, but expect probably status quo for the next 1 or 2 years, up and down.
Yeah, I think they've pushed out now the bottom of this cycle, as in this rate reduction cycle, out to 2027. So there may be something left in the tank. Again, it's all going to come down to the data, and the Reserve Bank governor has said, hey, they're being data driven in the way in which they're handling this, and they'll continue to do that. There's someone asked a question in the press conference, which was around macro sort of prudential restrictions on lending to try and slow down, what is seen to be housing affordability driven by lending. And she was pretty clear that that's a job for APRA. And
it always has been.
That. Yeah. But when APRA gets involved and needs to structurally change the rules governing lending is when there's something a bit more significant going on. I think that's some way away. But housing values rose, though, 1.1% in the month of October.
Absolutely, and one of the quickest rises of house price growth that we've seen in the last few years from a national standpoint. Every single market grew in value as far as major capital and major regional centre grew in value. Phil, we've been talking about this 3, 6, 9 months ago now consistently, and this doesn't even take into account the changes to the first home buyer grant aspect. So this data won't get better if you're trying to get into the market. Don't expect we're going to see anything going down anytime soon. And it's not just because prices are going up. It's the reason why, obviously. But ultimately, we've talked about this, that when you go through these higher interest rate cycles, which take more people out of the buying market into the rental market, coupled with less supply coming to market as far as existing properties being sold, you ultimately just put more pressure on the existing stock, and population growth is not changing ultimately, because that's the big issue that we've got in the inflationary conversation as well. So we need skilled workers. They're going to put pressure on housing. We need housing. That's not happening as much as it needs to. And ultimately, it's too expensive for developers to build this stuff. I sound like a broken record, mate, but the data keeps replicating what we're saying, and it's not going to change.
Yeah. So there was a dip in November and December of last year, and then 10 straight months of growth. And I think towards, I don't think you'll see that dip over November, December this year.
No.
Driven by these government stimulus in and around first time investing.
It might accelerate. I mean, year on year, it'll certainly be higher than what it was November, December, January last year, for sure.
And this is a dichotomy between policies which have been introduced with a view to try and support housing affordability, and it will make purchasing a property easier for a small cadre of first-home buyers who are quick to capitalise on that. But the outcome of this is just going to be less affordable.
Absolutely.
For most first-home buyers, for all the reasons you spoke about. Specifically, we're just not creating the supply. We're just creating greater demand.
And it's not. And I have to go back into this. It's not because no one wants to support the supply conversation. It's because it doesn't make economic sense for the actual private businesses, i.e. developers, to actually build more supply in a large number of areas that need the supply. And it's structurally extremely hard to change without some really big policy changes, because it has to be sacking up to a point where you can build a property with a margin and sell it with a margin and hold the property through the construction phase with a margin and still have the liquidity and get banks to support you. And we've seen some things change, and these are the things that unfortunately aren't going to help. They've seen the actual zoning laws change in a number of markets, particularly in New South Wales. And there was actually a report, ABC, I think, produced something a couple of hours ago. As of today, the Grattan Institute have put forward a report which is being considered. Again, it's the same stuff that we're hearing, which it frustrates me, because you spend millions on these reports, which talks about the ability or the reality of how to change supply to meet demand, which they're talking about essentially anything that's residential, showing a report that models out changing anything that's R2 or more, which effectively is residential land, allowing it to have 3 stories and a density of 0.7, 0.8% to 1. And saying that if we do that, then we'll reduce house prices over the next 10 years by circa $100,000 and rents by $1,800 a year over that time versus
just
where
by
they are
increasing
now.
Density.
By increasing density,
so
which
essentially
in turn creates more supply.
So turning over stock, so knocking down what's there, rebuilding something
creating
bigger.
more supply.
Yeah.
It's surprise. No duh. Like,
Yeah.
what does it take a PhD to tell people that that's what it's going to create more supply, property prices come down? It's an amazing concept.
Wow.
What we
Who
don't
would have
have, and again, New South Wales government they've put this out this year. They're changing supply, they're changing the density, the zoning everywhere, and there's going to be a New South Wales pattern book to medium and high density, which hasn't been released yet. And I've got a word on the street with someone I might have spoken to on Melbourne Cup Day, who was very high up in New South Wales planning, who said that it's going to be released in the next 4 weeks. There's some radical changes to what's going to be happening for medium and high density for CDC, and essentially you fit within a template. You can build 8 stories-ish, depending on the zoning and the pocket of land that you have. So it's going to create the ability to create really quick supply, but it doesn't address who's going to fund it and does it stack up. The same adage is there. You can change all these zoning laws. It doesn't make a difference. It still doesn't stack up. And this is the problem where we need skilled workers, i.e. labour.
So why is it uneconomical for developers? So there's 2 sides of this: uneconomical for developers, and it's largely uneconomical in relation to housing affordability for the purchaser. And dealing with that one first, from what I understand, 40-50% of the cost of the purchase of a new build is taxes and
costs.
Government fees.
Yeah.
So the government can pull a really big lever really, really quickly if they want to do that. But how does it actually change the narrative in the script then for the developer?
Well, the irony is here now is that with these first home buyer grant changes, you're actually helping the developer to a degree, because prices are increasing for the equivalent product. And if prices go up, the developer thinks my margins are a little better, increases. So I can actually now start to come close to justifying. So they ride the fat. They have to. Yeah. Because, I mean, I develop property and I look at this on a day in, day out basis, because if I can't see an end sale price here, I can't justify building a property for this price here. And also I can't go to the bank with a approved DA and a fixed price contract to say, here's a property I'm going to build, here's the sale price, can I have the money please? Ultimately, they look at it and say they need to see a margin that is their comfort level to then lend the money. And that will address when prices go up, it does help, but then you still have to address, because you can't expect prices to go up all the time, especially as a developer. You can't bank on holding a property until prices go up to the point where you actually have a margin. So there is always this concept of you need to figure out how to get, and we've seen that increase of 40, 45, 50% increase in cost of building an equivalent property over the last 3 or 4 years, which has completely eroded the margin. So that will just ultimately take quite some time to come back into equilibrium. So we have to sit on our hands for a fair bit.
So dwelling approvals are down 6% for the month and down 3% versus long-term average. And supply side perspective, advertised stock levels are also low, tracking 40% below the same time last year and 90% versus the 5-year average.
And that's a crazy stat because we've got more supply than 5 years ago, yet they're tracking 19% lower than the same time 5 years ago.
So the demand is out of kilter with supply.
Absolutely.
That's all it is. You know, mate, this is
wild.
a kindergarten kid could probably tell you that, right?
Exactly.
So something's out of kilter, but what does it all mean? Well, if you have property, it's probably going to continue its run.
Absolutely. And probably one thing that's not necessarily highlighted here is rental growth has actually started its uptick again. It went from its heady heights of sort of the back end of COVID, softened a bit as we saw that the borders reopened and all those things happened, and then it came down, and now it's starting to see I think it's fourth consecutive month of rental growth, and that's broad based. So we're seeing rental growth increase, we're seeing vacancy rates hover around their all-time lows still, and obviously new property supply is still tracking extremely low. So we're at a point now where rents are going to get better as far as the yield for investors. The vacancy rates are low, so the risk of seeing property sit vacant for extended periods of time is still highly mitigated. Property prices are growing and supply is remaining low. So
another thing here for investors, and this come out, and unless you're sort of in tune with it, you might have missed it. But it's of significance. Macquarie Bank has paused new lending to trusts and companies. So this is from 1 February. So they pretty much said they're not going to be issuing new finance to property investors who invest in trust structures and or company structures. And you would say, well, yeah, so what? That doesn't really matter too much for many people. Well, they've said, and this is a story on brokerdaily.au, the decision was driven by a range of factors. A quote with application, and this is from, so these people here at Broker Daily saw some correspondence that they sent out to mortgage brokers, right? So they said, with application volumes increasing, we're adjusting our approach to ensure we continue delivering market-leading turnaround times with high service standards for brokers and consumers. Yeah, that's just a bit hyperbole from the bank. So what? It also lasted, this is the important bit, the emergence of strategies on social media aimed at maximising lending through trusts and companies. They also said upcoming anti-money laundering tranche 2 regulations require additional verification steps for trust and company loans, making the origination process more complex and time-consuming for banks, brokers, and consumers. Also cited, they're saying it's going to be over-compliant, it's going to take more time, and therefore erode the economics of them doing this business.
Yep.
And I'll probably say also for brokers, you know, it's a lot more work for them to go through this. So it's an erosion of productivity of dollars. But I think the key thing here is a cloak, is the emergence of strategy on social media is aimed at maximising lending through trusts and companies. And we all see this stuff. This is where you're on your social media and say, invest in a trust and you can keep borrowing when your serviceability is tapped out. What do you say about that?
Cheers to that. I mean, the reality is, there are places for trusts, but I think the absolute explosion of this concept over the last probably 18 to 24 months, and Phil, you and I have spoken about a lot, multiple different times, not just you and I, about the risks associated with it and the fact that it isn't something which is sustainable, coupled with the fact that accountants who know their onions talk about this as well, saying, yes, technically there's a loophole there, but you have to then therefore be able to be confident and comfortable that your accountant can validate the fact that you can hold a number of properties in trusts and keep them cash flow positive. Because the concept is that you buy a property, put it in a trust, that property by the way of moving around some numbers in the background, it may not technically be cash flow positive, but on paper, from an annual taxation report perspective, shows that it's even $1 cash flow positive. In a lot of cases, the intent there is to actually say, okay, well, for a future application, we can actually neglect the fact that that property is part of your P&L because it's positive. All of a sudden, your actual borrowing capacity doesn't decrease by adding that property in, and you reset and you reset and you reset. And the I guess the promise is that this is it's the panacea, right? It's the way to grow an infinite property portfolio. It's simply not the case. It never has been the case. But there was a loophole that people were trying to, certain people, and I'd say there's certain people in the buyer's agency, property investment advice space who may have been masquerading that as something that is a way to keep doing it. There are certain people that trusts make sense and they belong in trust for asset protection and also for a lot of people who aren't PAYG. There is a lot of sense in a lot of these structures, but for the majority, it never made sense and it shouldn't be there.
And this is the issue I have with it is that there's a justifiable reason for some investors to invest in a trust, right? I hold a lot of stuff in trust. I'm only a inkling away from getting sued at any point in time for something I say on a podcast. Yeah, asset protection, right? Yeah, asset protection.
Correct. That makes sense.
It makes sense. But I've spoken about this with accountants, one in particular, Munzarul Khan, who we both know, and most of you who tune in this may have heard of him. And I've spoken to him over this for some time, and he's going, how often people just say, can you write me an accountant's letter that says, and he goes, no.
Absolutely.
Your trust isn't positive. And he telegraphed this a long time ago, saying this is going to become an issue, and it wouldn't surprise him. And I agree with this, and that there may even be greater intervention around this as well.
And I hope there is, because
so you want to keep APRA away from it. Like if the industry can self-regulate and do this right, but the issue you have though is that what about people who actually want to invest in trust?
Well, there's got to be.
They're just going to get marginalised
they're going to cop high rates. I mean, I buy in trust. So do you, Phil. But I guess the properties that we talked about this off air, the properties I personally buy in trusts aren't to necessarily create benefit from this loophole. They're for different things. They're typically development sites that need to be in companies or trust structures for different reasons and asset and essentially protection, distribution, all those types of things. Yeah. That's why they existed in the first place. That's why they were set up that way. But I actually like the fact that banks are probably now considering what's happening out there in the social airwaves as things that they need to be aware of and then need to make decisions on. Because like you said, Phil, self-regulation is where we always want to be.
Well, but individuals should be self-regulating themselves.
They should.
Right, that's where property investment starts and ends, right? Yeah. Yes, you use people to help shape your decision-making strategy, but you've got to be self-regulated. So when I see new investors come in, so they buy their first investment property in a trust, I go, who gave you that advice? Like, why? Oh, because I'm going to build a 100 property portfolio. And you go, you're probably not going to do that.
Yeah, it's unnecessary.
It's you're not, number one, the likelihood of you building a 100 property portfolio is very, very low.
Yep.
You just need to look at the stats, right? And number two, if that's what you want to do, that's fine. But any good accountant will tell you, buy the first couple in your own name.
Absolutely. Exhaust the taxation opportunities that are on offer and use all of that. That's going to be yours.
Because a lot there. You get breaks depending where you are investing on
land tax,
on
negative
land tax.
Gearing, depreciation. You still get a CGT discount if you sell of the 25%, the 50% rather. There's all kinds of benefits for the person.
So this is going to be an ongoing story. Brokers have come out. There's a follow-up story here. Commentary here. There's one from Eva Loisons, who we all know from Finney Mortgages. She told Broker Daily the shift will reshape investor behaviour and broker strategies and signals a quote pushback against loophole-driven lending.
Good, yeah, here.
Quote continues, for clients using these structures, often for asset protection, tax planning, it may reduce borrowing capacity, delay approvals, or force to move to personal name lending. Multi-property investors, and specifically those influenced by social media spruikers promoting complex structures, will be particularly affected.
Good.
There you go. Echoes your sentiments. There's a whole bunch of other things. There's a quote here from Adam Bradley, Emerge Finance Director. He goes, it's a big shame, particularly for the reason for it. There's obviously been some influencers or people trying to muck around with the system so that people are getting additional borrowing capacity. Quote continues, but for the most part, I think everyone's doing the right thing.
And they are. I mean, I speak to thousands of them.
Yeah, Eva says here, another quote here, the whole industry is concerned over spruiker strategies. The rise of social-driven lending tactics and encouraging brokers to use trust or companies to bypass serviceability limits has raised red flags across the sector for a long time. Go Mortgage Brokers here, Xavier Quenon. It sounds as if the two main motivators for stopping are concerns about influence doing the wrong thing and pressure from government regulation. So it seems red tape would generate worse outcome for customers. Yeah, you don't want the government to regulate this. We need self-regulation.
Completely.
And that is the roles and responsibilities of the professionals that work in this space to champion that. So, if you've been tuning into this show for a decade, obviously we cover all this sort of stuff and we have a very measured and conservative approach to these type of things. Trust may work and can work for the right type of borrower. They can also be a hindrance
Absolutely.
for other borrowers' action.
And you've spoken about the hindrance to you a lot.
Limiting your serviceability, potentially.
Massively. Limiting your cash flow.
All this sort of stuff. So in the balance of things, investing in trust might be the right thing. It might not be the right thing. So no matter what you do, you're going to have to pay tax along the way.
Yep.
So find out the right solution structure for you. But we can pick that up later on. We actually have a guest joining us, dialing in all the way from the independent Republic of Western Australia, Sam Beckett. He's been working with Pure Property for the last couple of years. From what I understand, Paul has put together a pretty reasonable strategy for him as he embarks on creating wealth through property. You're going to see him jumping online. He's tuning in. It's pretty early over at West Australia. But Sam, how you going? Good to see you, mate.
Can you guys hear me?
Loud and clear, buddy.
We can, mate. Have you been tuning into what we've been rabbiting on about? What does all that mean to you? Anything?
Yeah, no, it definitely means means a lot, because I suppose it's against that point now as I'm progressing with my own property portfolio. I think it's gone from giving that first investment property a crack to then now proceeding the recent purchases with Paul at Pure Property. It's really have to be in tune with the the actual economic picture of Australia. And even what you were saying, about the trust borrowing and I suppose, buying your personal name, the trust lending. It's definitely interesting because, I've sort of gone through that myself with my personal name, and then stepping up into the trust for the asset protection. And then, using it, as a structure to try and grow the portfolio. But again, do it in the right way, and just try and follow those guidelines as closely as I can.
Give us a sense for your portfolio now, Sam. Just value, equity, number.
So basically, just settled on. Well, how can I put it? Yes, basically I got 4 properties at the moment. So been pretty lucky. So each property so far has doubled. So it's been pretty good. So I think the portfolio is sitting around be about 2 mil at the moment. And then the equity at that, be about, a 40% LVR. So it's been pretty good.
Mm.
So you think you've been lucky, do you?
I don't know. I mean, it does feel a little bit lucky. But I think it's also just sort of been with the strategy, and then also, I suppose following that professional advice that has, led to this. So I suppose it's a combination of, it does feel lucky, but it also does feel the actual strategy is paying off, which is good.
Lee Trevino famously said, Philip, the more you practice, luckier he gets.
Do you know what's really funny? Lucky is a really insightful concept to people. And I can't remember who told me once, but I still do this. And if you employ people, I highly encourage you to do this. When you're in a job interview, at some point go, well, do you think you've been lucky in life? And it throws everyone. And how they answer that question will give you such an insight into their mindset.
Do you think the glass half full, half empty sort of mindset, or is it more how they perceive luck versus
it's how they perceive
hard
luck.
work?
It's how they perceive luck versus effort versus energy versus strategy versus tactics.
Yeah.
And a lot of people go, I've been hugely lucky.
Yeah.
And then they'll give a narrative around it,
Yeah.
which is, to Sam's point, focus, driven strategy, right people, right thought. That's what produces luck. Practice and repetition.
Absolutely.
Yeah.
And one thing I haven't ever heard from clients that I've spoken to who haven't yet bought property is they've never said that they've been lucky in property.
No.
The irony of this process is that
been unlucky.
You could say you've certainly been unlucky, or I missed the timing, or I was just unlucky, I wasn't ready. I tell you what, anyone who's taken action in a measured way, i.e. Sam's position, have they been lucky? Well, yeah, you can perceive it as luck.
Yeah.
A lot of perceive it as hard work and preparedness. But it's a combination of all those things.
And you can have a veneer of luckiness as well, right?
Mate,
I've been hugely lucky, but
every single person who's probably listening to this is lucky in some way, shape, or form. The fact that they have the ability and the freedom to absorb this kind of content on a free basis on a device that they are probably remote. I mean, 15 years ago, this didn't exist, and here we are, throwing this stuff out, and they've got the ability to go down that pathway.
So how did you end up working with Pure Property, Sam? What's the sort of connection, or how did that originate?
Yeah, so I suppose I'll give you my full rundown. So
give us the CV. Yeah,
the full CV. So I suppose we're currently. So I'm 29. I've been in the Navy for 9 years, and then I think so. Basically, I've done my first 3 years in the Navy. I had a couple of deployments under my belt, and it was getting to the point where I was like ready to pretty much buy my first property. I wasn't sure what that was going to look like, so I was like, 24. It's 2019. I'm thinking, do I buy my own like PPOR? Do I buy an investment property, or do I build? Because that was at the time, they were throwing out like the building grants. And then funny enough, one of the Navy boys actually recommended the Smart Property Investment Show. And then, they were saying, Phil sounds like he knows what he's talking about, and so does Paul.
I thought people in the Navy were smart.
They were like, they both sound all right. Maybe
mate, to be fair, I know a lot of people on deployment that while the hours away tuning into the dross that I typically sort of talk about. But anyway, continue.
Yeah, so that was basically that. So that's what basically sparks my interest, was the Smart Property Investment Show. I actually began to first of all educate myself on property investment. So I listened to it, driving to and from base. I was doing like, say, courses, and then so pretty much, every time I was in the car, in the gym, I was just listening to the podcast, and started learning about rent vesting, the benefits of rent vesting, and then with Paul jumping on, representing like Pure Property, and then so that's pretty much how it started. So I was like, I made a decision, I'm going to use Paul as a buyer's agent. At the time, you guys were talking about, like how Brisbane was looking promising. So that's pretty much how it started. For the Smart Investment Show, got on to Paul, cool. And then been moving forward from there.
So you're still serving, still in the Navy?
So coming towards the end of it now. So done 9 years, okay. And had a couple like medical. A couple of medical issues of like like a few surgeries and complications. So I'm like because they're looking to separate probably medically next year. But but throughout that whole time, just been trying to just push that money into the portfolio. And I think that's what like really gave me that push, was like, the Navy and the military pretty tough, deployments and stuff. And I'm like, it's just sort of gets to the point where you don't want to be doing that your whole life. And I'm like, all right, well, in what way can I create a passive income wealth? And then I pretty much chose property as that avenue. And
Well, importantly and firstly, thanks for your service. Much appreciated.
No worries.
So what sort of work were you doing in the Navy? Yeah, on ships, you're base-based?
No, I was a submarine technician.
Okay.
So marine technician, submariner. So basically maintain and operate the submarine as a whole. So all the equipment, the consoles, a Sparky by trade. So doing all the electrical stuff on board, and all the cool stuff, like, so it's like, without the torpedoes, and then like the tubes, and like, the and testing, and
that's proper work on subs. A unique breed on
Yeah.
submarines. I know quite a few of them, and
Oh, wow.
yeah, that's absolutely brilliant. But most sailors that I know typically blow their money on a fast car and jet skis and holidays and, inverted commas,
Yeah.
pissing up against the wall. So good work not doing that. But I think that and there's a huge opportunity, I think, for people who work as first responders or in the military to capitalise on that time to really double down and make hay. So you've invested in yourself and you invested in a future, leveraging reasonable sort of dough and good sort of perks working in the Navy. So anyone else out there who is serving, this is the sort of thing you want to try and emulate. So 4 properties now. Are you happy with the direction? You happy with how it's all going? Like, and how much further you're going to keep going with this? You're still a young bloke.
Yeah, so I suppose so pretty much. So I bought the first property with Paul at Pure Property. That did really well, so I bought that in 2019. And then I recently just sold that in June. So I paid full transparency. So bought it in Caboolture. Absolutely, that property absolutely cleared me out. I had 70 grand to my name, sold my dream car, bought that, and then I felt like
so you actually had a car.
He literally did all the things, but it had a massive pivot to do that.
Massive pivot, yeah. So pretty much that whole thing, 24, sold my dream car. I did have the big fancy, Nissan Patrol, 4-inch, 35-inch tires. I'm not compensating whatsoever, but had to sell it, and then that got me into the first property. So then basically pulled out a lot of equity over that from the years. So I got the second one. I did sin. I went with another buyer's agent that was on the podcast as well. And then got another one after that, and then came back to Paul again for the 4th property. Because I think overall it was just sort of I just really liked the way that Paul and Pure Property actually work, and it feels very personable. The people that they refer you to are very good. And then so then I sold that first property. That took me down to 3, but that propelled me forward. So I sold that for 770, which is amazing. I made 440 grand off that one property, which was the most amount of money I've ever seen, or never even thought I'd ever make in my life, and then reinvested all of that money recently. So just settled on the first purchase that we've made in Victoria.
Okay, whereabouts?
So it was Hamlin Heights in Geelong. So one of those things that was just too good to say no. It's really nice, 1-bedroom unit, super cheap, 300k, but it's 6% yield. So it's more or less positive off the bat, and I can slot that straight into the trust, and then push forward onto another 3 of those deals. So similar sort of prices. So I got one in Warragul, Belmont, and most recently Wendouree. All around that sort of 300k purchase price, 6% yields, and it just makes so much sense to me, because I'm for the money I've got to put down to get into it, I can put down a big deposit. It's got a 6% yield. It's pretty much positive off the bat. I can get it in the trust. I can keep moving forward, and then most recently decided to go for a bit more of a I suppose quality freestanding asset, 3 or 4 bedroom. We're sort of budgeting 600 to potentially 775,000.
We're on the hunt for that one at the moment.
Where are you looking?
We're probably going to be still in that Victorian market for that intentionally before we sort of close that out at this stage. And it's the growth has come from other properties in other areas as well. So it's not that it's going to be a hyper concentrated just because Victoria is fantastic for everyone right now. But I think Sam's a good example that he has followed the data and bought, and a lot of those markets, to his earlier point, have done exceptional, far quicker growth than what I would have otherwise anticipated. But, there's always got to be that moment. And I think we have constant communication, Sam and I, on a pretty regular basis, where you've got to be comfortable with the cards that you have, or do you shuffle the deck at a point where you're like, okay, well, this has done exactly what we were hoping it to do in a 10 to 15 year period, in a 4 or 5 year period. So ultimately, do we hold, or is it time to say, take that profit? And I think to Sam's point with the properties that he's bought, and I know it's earlier to what we're talking about with trusts, Sam's bought properties in trust intentionally for this second round because ultimately they are cash flow positive. They're not because they're going to be supported by an accountant's letter or something that's a bit onerous that doesn't really exactly make sense. And the ability for him to actually put physical cash deposits in, non-leverage cash deposits in, gives it much more stability. And ultimately, those properties actually are physically cash flow positive from the moment that they were settled. And he's going to be coupling those with probably more. This next one will be probably more of a negative asset potentially, not dramatically, but it'll be supported by the other assets with more of a lean towards land and growth. But you can balance it out because he's physically transferred what was the sale of a car to a deposit to a purchase that more than doubled in value to selling that, taking that physical cash and now distributing that across assets, which for me, that's the panacea. That's what you're working towards.
Yeah, and so sorry to be cliche, so we're saying, oh, you go and buy a fancy car and do all that, but it's education and awareness and knowledge and all this sort of stuff, right? And fortunately, I think, we caught you early enough in the process before it was too late going down that rabbit hole, right? Because it can be tough to, get out of. You take on big debts against depreciating assets, and
you can't get out. You constantly dig.
You dig. So, a great case study for number one, understanding the opportunities and benefits through further education and doing something about it, and then actually taking action from it. So it's pretty good. Yeah,
I look at it's a sliding doors moment, right? Like we caught up 6 odd years ago, and since then there's $1 million upside from that one catch up, and it's not been through, hey, let's go throw a hook shot from halfway and close our eyes and hope that it goes in. It's just been, okay, well, let's start with this one, and that one led to, okay, that's done exactly what we would hoped it would do. It can go to here. It wasn't a 5-property plan in 5 years.
No.
For most people, that's just not realistic. The part comes in those regular catch-ups. Hey, this is done really well. There's time to maybe release equity there. Your borrowing capacity, it's there. We can probably go here. And that conversation kept evolving.
Yeah.
Because that's the biggest thing as well. Because even at the time when I was, that first property, it is pretty much that crossroads of, what do I do? Do I build, buy the PPR, do I invest? And then I remember actually speaking to Paul at the time with regards to actually investing, and I was, saying, just having an honest conversation about, would it make sense to build the building grants? And then we were talking about that, and then how it's like could be beneficial, but it's sort of like, I'd be building in like an oversupplied area. It'd be me and everyone else building a house. And if I were trying to rent it out, there's that whole oversupply for everyone else trying to rent it out. It just didn't make sense. Whereas like for me to then, spend that 70 grand from, selling the car and stuff and then investing in Brisbane. But it was also because of like with me investing into states, it didn't conflict with like, my benefit of like rent assistance in the Navy. Because I was like, well, if I'm in the Navy, I'm doing deployments, may as well utilize that benefit. Whereas like, say, if I invest in a different state, it means that I don't lose my benefit. Whereas if I invested in Perth, I would lose my rent assistance because Navy sees it as like, oh, you've got a house you can live in. Why are we going to help you out? So I think it was just that sort of like just doing all the homework I could, and then, just really weighing up those pros and negatives and being like, it just, it makes sense to invest in a market that's about to boom. I can get a 4-bedroom house for, 340 grand, 70 grand down. Yeah, it's going to wipe me out, but I'm going to be doing future deployments to the Navy, get back into saving this and that, start working towards that second property. And yeah, it just made sense. But I think the biggest thing was just following my gut as well. Like, getting all the advice, speaking to Paul, listening to, yourself, Phil, on the property podcast, like all the gears you'd have on there, and then making that really sort of like educated decision.
So entertain me. I'd love the idea of one of the boats that we have sort of somewhere out in some far pung of the world, and everyone waiting just to get a mast up to get a signal so they can all download the latest episode of the Smart Property Investment Show. Please tell me this happens. Please tell me this happens.
Imagine,
yeah, 100%. Yeah, we're in undisclosed areas.
Undisclosed areas. Captain, we got look up to the next episode meeting. Can you just go? All we just need.
We need 40 minutes for a download.
Everyone's walking around like haggard, like they've not had any food or water, but all they want is
just got headphones,
and the captain's there going, we've got a problem with morale. The food's great. There's canned peaches. We can have as many as we want, but we need our next installment of the Smart Property Investment Show. I'll tell you the best way to save money: being stuck in a tube somewhere under the water somewhere where you can't spend it. Right?
That was it. I think that was the thing as well, and that's why it was definitely tough, but I kept pushing myself onto the submarines because I was I progressed my career because that's the whole thing of always heard about with property is pretty much the more money I earn, the more money I can borrow. So it was how to earn more money, get myself more highly qualified with the Navy so I can get the relevant pay rises, do the 3-month tube deployments where I literally can't spend $1 until you get to the port and then you spend a bit of money, but then you feel a bit sorry about yourself. And then you get back into
one
saving.
hangover, you just go, that's it, mate.
Yeah, that's it. It's just one hangover, you can't spend that much money in one night.
We've got a mutual friend who was a former Navy servant, and he'd testify that he can spend a lot of money in one night.
He can do, mate. He did everything wrong, that bloke. Everything, career-wise, financially, friend-wise, absolutely everything. But to your point, though, if you are serving in the Defence Forces, there's just another layer of strategic sort of decision making you need, and that's how to really understand and I don't want to use the word exploit, but how to best use the grants available for you, because they are confusing. They've got a lot of terms and conditions, so you really need to understand how to gamify that in order to get the best outcomes. And you spoke to that.
There's another one as well that sort of makes it a little bit confusing because it's another sort of scam. I suppose might go too far into defense stuff, but it's just a little bit relevant because it's the home, the HPAS scheme. So it's basically if you buy a property to live in, you get a grant. It's not much. I think it's I suppose it's still a decent chunk. I think it works out to be about 15 grand, but it's even with that for me, because I was at the time I was I'm going to be doing, long-term Navy career. If I buy in Perth, I'm going to be ball and chain to a 30-year mortgage. I was I'm single, boom, buying it in my own name. I was I don't want to risk, say losing that property to the de factors. I don't know. It's just so many things that go through your head. And I was just again, with it's just again, didn't make sense. So I was I'm going to sacrifice that homeowner assistance scheme. I'm going to sacrifice that, but I'm going to utilize the rent assistance and then invest in a different area.
Yeah, you're a subsidised rent investor. There you go.
That's
I'd be doing it.
But I mean, and it never ceases to amaze me. I mean, it's the biggest employer in this country, right? But the amount of people who probably don't go down the rabbit hole enough to actually figure out what's available to them and just take the easy wins, which some of the best stories I have as clients are in the Defence Force, and I can think of dozens who have started with one and have realised that once you start on that first, you kind of make a decision because you're not going down the defence housing pathway or that home buy pathway, because once you start to think, okay, I live here, I can't buy within this radius if I don't want to utilise the grants that are available to me. Once you go borderless, they realise, well, hang on, I can reset this. And Sam's story is, whilst it's amazing, it shouldn't be unique. It's not like he's had anything that's been luck beyond what is achievable for most in that position if they apply themselves. And this is a 6-year, 7-year time frame. Sam's still not 30 yet. I mean, he's got so long in his career and life, but has already achieved far more than most property investors ever will do, even active property investors, by just applying what's available to him.
One of the challenges for the Defence Force is retention. And we should be trying to attract the best and brightest talent we have into our Defence Forces and keep them there. And what I would say to that is, I think a lot more work, and maybe Sammy gives some insights on this, a lot more work could be done in educating our serving men and women around creating wealth in parallel with serving the nation. And these grants are brilliant, but I think if it was conceptualized and there was greater education, helping people to actually understand this and leverage these incentives that connect around with it, will certainly help with retention.
Absolutely,
certainly help with retention. I don't know, Sam. When you're sitting around a mess, do you guys talk property and stuff, or is it who's got the biggest lift kit on their Nissan Patrol?
bit of both. It's a bit of both. It's still a bit of a swinging contest. You know what I mean? It's like how big is your lift and how many properties you got. You know, oh, my lift 4 inches. Oh, but I got 2 properties.
Maybe you can do an index, right? Like, you know, like
we do like index. We got like flow charts. So, you know, like technicians, we get the flow charts out. You're like, right, your property, like, you've got 2, and I've got a 4-inch lift. So how's that?
Yeah.
Like,
I'm going to give you 2 points for every inch of your lift versus.
Yeah, that's it. Yeah, but no, it's because I mean, like, I think it's just sort of that. It's that sort of nature and demographic of like people. I think it's because you know you join the defense and you sort of like there's always that little bit of like, you know, that everyone's sacrificing something. You're sacrificing being away from your family, your friends, and you all sort of like end up in this network together of, you know, with a joint idea of like pretty much, you know, protecting and serving the country. You know, if we get sent to war tomorrow, it's like you've signed on the line, you're going. And then so I think it was with that, and when you do start, like, I suppose, earning that like consistent money, and say if you're living on base in the barracks and stuff, you start getting to the point where a little bit you go like, I'm actually earning a bit of money here and I'm not spending it, and how can I actually leverage that? A lot of people, you know, there's still that whole thing of like, you know, you can just go blow it on the piss and on your cars. But it was one of the boys actually recommended to me was, first of all, you know, the Barefoot Investor book.
Yeah. Scott Patter's good. It's good start.
Even he was, you know, the Barefoot Investor, he's very much against property investment, but I think it was just that, like, sort of like, you know, let's actually try and start saving a bit of money here, and people start switching on money because you start, you know, thinking, oh, I'm going to be deployed for 3 months, so I'm going to have all this money when I get back. What do I do with it? And then, I think it was just start building that bit of a network. But essentially, it's not as if it's like what you were saying. It's not, information isn't readily available. You know what I mean? It's like when you join the Navy, no one's going, oh, you know, if you join the Navy or you join defense, you can get, you know, your rent assistance, and then you can maybe buy an investment property. You can start creating wealth. It's all very sort of like not kept hush hush, but it's like you have to do the digging, and it's all sort of word of mouth, and you have to dig through like the Pac-Man. The Pac-Man is like the pay and entitlements manual. You literally have to go through that. You know, you have to find out, what am I actually entitled to, because you're not exactly told, and you have to try and figure out, you know, how am I actually gonna like leverage this? Because if I'm doing the time, I may as well use these benefits, because it's like, you know, pretty much sacrificing your body and your mental health, you know, while you're away. So it's like, I want to come back to something, and it does take a lot of digging, you know, to actually find out, you know, what am I entitled to? How can I actually use it? And how can I actually sort of like better myself? So it's definitely, and there's a lot of word of mouth, you know, people sort of like talking in the messes, and it is that whole thing of, oh, you know, you come back from deployment, you know, how much 30 grand to his name, you can go and buy that 4-inch lift. Or, you know, one of the boys who's like, you should buy an investment property. You know what I mean? And I was like, buying an investment property sounds pretty good.
Yeah. And mate, there's no reason why people shouldn't be exploring this, and take the defense out of the equation here. I think if you substitute that for anyone in a PAYG scenario, particularly if I look at equivalents or substitutes of if you've entered the workforce on a income, whether it's a graduate salary or whether you're finishing an apprenticeship and now you're in a full-time job and you're living at home, treat that as the same thing as rental assistance, because you might not
get
be
your washing done, you get your food done, mate,
and
you
it's
get everything
subsidised,
home, right?
And
so it's fully subsidised by the parents.
The subsidy can be
same.
different, but I think this is it. Like the more and more I explore this channel, and the longer Pure Property Investment podcast, or the Pure Property podcast rather, continues to go out there, the more I'm finding I'm getting those people who are probably in similar positions to Sam, whether they're from defence, whether their graduate salaries have managed to put together their first home buyer deposit or first investment deposit cash, or they might also have that combined with parents happy to go guarantor to get them started, but they're using their ability to borrow money. The leverage is the one that people just don't realize. Once you delay it 1, 2, 3, 4 years, you don't get that time back to get that money in the market. So you need to start thinking, get yourself educated, get wise, get the conversations going, join the groups that talk about this stuff and aren't trying to sell you anything as soon as you possibly can. Muster up that information and make a decision. But ideally, the lift kit comes after the first property.
Well, I think there's a sense of conservativeness around this, and you know, same analogy. You know, so someone in the Defence Force, right? It is a hugely stable, guaranteed job.
Correct.
Right. But there's analogues to that. You know, cops, first responders, ambos, etc., fireys, nurses,
Teachers.
teachers.
Yeah, you've got
Like there's a litany of people in very similar, which is largely guaranteed employment and continuity for a career, right? It's absolutely brilliant. PAYG, you're going to get a check every fortnight or month, right?
Yep.
And there's lots of Australians out there. So you put things into perspective. You listen to the Smart Property Investment Show, you think everyone's some sort of entrepreneur doing this, that, and the other. Like this is the heartbeat of our audience in the community as property investors are people in these positions. Now, you talk to a lot of them and they might be a bit fatigued with their job. They'll be going, mate, sailors like a grumble more than anyone, right? Like they'll tell you all the things that are, annoying them, and that's your right to actually grumble, right? But by and large, it's a good job. Same with cops. Lots of cops, they'll complain about it, but they love their job.
Yeah.
Nurses, they'll complain about the hours, but they love their jobs. But they always see this sort of shiny little thing over here on social media, wherever they go, oh, I should be doing that. Why don't I have my own cosmetics line selling, why aren't I living in Bali selling batik sarongs and living a glamorous life, right? That is not real. However, if you have good, strong, stable employment and continuity of your career, if you want to take control, property investment is the great Australian side hustle for PAYG.
The vast majority.
You can take control of your future. You can be as involved as you want. You can be the master of your own destiny. You can be the CEO of your own property company, which is what you are.
Absolutely.
And you do it all in the ways where you've got largely guaranteed cash flow from your income.
And I have no doubt
that's probably your, I would say, a lot of your client base would be people like that.
They are a lot of the time rather they don't know that's what they are trying to find is the ability to be the CEO of their own business, which is a small, essentially a property providing business, a rental accommodation business. That's what you're in business of delivering and providing and keeping it safe and profitable. That is ultimately your mandate as a property investor, whether it's one or out to 5 or 15 or 20. And Sam's case is exactly that for most people. Sam started probably a lot younger than most, and therefore his returns will come sooner than most. And I have no doubt that fast forward 10, 15 years from today out to 2035, 2040, Sam will have choices, whether he wants to have that life or that business over in Bali or raise a family in Perth or whatever the hell it might be. He's going to have those choices because of the trees that he planted when he was in his early to mid-20s and made those decisions to stick with it. But to your point, Phil, your mindset needs to be, hey, I don't just buy one property and stop there either, because vast majority of the time that's not going to do the job. But it doesn't also have to think I need to get to 15, 20, 30 properties. The balance is circa somewhere between the value of $2 to $3 million in gross value, giving that 15 to 20 years will do the work for you. Now, with however many properties made up of that $2 to $3 million in gross value, that depends on the strategy, the cash flow requirements, etc. But the mindset should be, how do I get there? And then I remain a really good quality owner and landlord of these properties, maintain my cash flow, maintain the properties in a way I need to, let the market do its work, and give myself time, enjoy my life whilst that's happening, because that's probably the most key part to all of this, is that we don't want to sacrifice 10, 15, 20 years of the prime, whatever time you're in, that is your prime. And we want to make sure that you can get through it, and at the other end, you thank yourself for it.
There you go. Well, Sam, we're going to sign off, mate. You probably got to get to work, but what I would say to all those Aussies out there, there's a lot of talk around Australia getting a whole new fleet of submarines, and there's a good reason why we're spending all that money. It's because of the important work our submariners do, and largely no one, unless you're involved in that, will really know the work that they do and why they do it, but there's a good reason for it. So, mate, Sam, to you and your colleagues, mate, keep up the great work, what you're doing out there. Certainly appreciated. And for all your colleagues also, tell them to listen to Smart Property Investment Show. Stop blowing their dough on lift kits. Mate, we've got 10 years of me gibbering and jabbering on around property, mate. And if you can make that shift and that mindset earlier on in your career, you can make some good dough out of it, mate. So I wish you all the best.
Yeah, thank you. It really means a lot. I think that's another thing I'll just add in as well. Like, it is all like relative as well, sort of like whether someone's working, like no matter what job you do, like what you're saying, if you're a teacher, say you're working in the mines, like there's always that like ability where you can you can think to yourself, right, on the weekends, what do I do on the weekends? Can I get that second job? Can I work those extra hours? Like, it's sort of like, it's all relative to your situations, to like, no matter what you can do to actually try and like earn that extra dollar to then, try and build that picture of getting into that first property, that second property. It's like there's always so much opportunity for like people to just progress themselves and better themselves. And like, what you were saying about the podcast, and let's live in a world where it's like literally, you do have 10 years of Phil talking about property. It's like use that information and collect it all, and then work those extra hours, get that property, like, make it fit the dynamic that's relative to you, and, like just run with it. But it does take that initial sort of like, sacrifice, and that sort of continued sacrifice and conscious choice to get there. No matter whether you're defense, police, no matter what you are, there's always something that you can do to help yourself to then like, leverage yourself moving forward.
Well, I think we should do a podcast a little bit more on people that work in these type of professions, and the only reason why I say is like, I know some fireys and cops, right? A lot of cops do, 4 days on, 3 days off.
Absolutely.
A lot of fireys do
2 days on,
2 days off.
Yeah.
Like you can be largely a full-time property renovator.
Too many fireys who don't have a second job.
They have your second job could be doing up proproperties.
Absolutely could be.
And that's flexible, right? Like
Completely.
you've got so many things to exploit. But Sam, thanks, mate. Really appreciate your time.
Thanks, Sam.
Paul, well, it's good to see he's come back to Pure Property. I thought you would have sort of turned your back on him and say he's dead to me.
Never.
He's dead to me.
Never.
No. But if anyone wants to have a yarn to you.
Mate, the same way Sam reached out to us probably 6 years ago today. So shoot us an email, inquiry@purepropertyinvestment.com, or they can give us a call at 1300 985 428. Either way, set up some time, get that journey kicked off, and ideally, allow time to do its work, just like Sam has.
Nice one. Well, thanks for tuning in, everyone, to this Pure Property podcast with Paul Glossop. Remember, Christmas is just around the corner. Get the book. Get the book.
You should hold that, Phil.
Really?
Yeah.
No, I don't like to endorse anything.
You just did. Turn it to the camera.
It's super Phil. Is that you surfing on the front cover?
It's me holding a surfboard.
That's Paul. By the way, there's no surfing photos in here.
I think there
at
is.
all.
There's one of me paddling somewhere, not standing up physically.
Is any of Phil on the beach? Maybe some people will, there's
a calendar coming out.
There's a Phil Tarrant calendar.
Oh,
there's another one of you. Same photo.
Yeah.
You do a two for one bundle, stocking bundle. We've got the Phil Tarrant calendar.
What about surfing with Paul and Phil? One, there we go, the prize. Same photo again. But look, Phil doesn't make anything from these endorsements. That much I do know. No, I get nothing.
Neither do I,
No.
for that matter.
No, anyway, we've got to go. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.